After 3 strong years for stocks, could 2026 be more about consolidation than big gains? Well, as we head into the final trading sessions of 2025, the S&P 500 is up a little over 15% year to date. Now, stronger dollar and higher yields could add pressure early on, but any increase in volatility may also create some opportunities. Well, joining me here at the New York Stock Exchange this morning to weigh in is Mark Newton, Head of Technical Research at Fundstrat. Mark, happy holidays. Great to have you here.
Thank you very much. Happy holidays to you.
Well, thank you. Well, 2025 has been quite the year when it comes to all asset classes, not just here in the U.S., but around the globe. So what are your expectations as we head into 2026?
Well, look, I think it's going to be so-called the year that refreshes, the pause that refreshes. It could be a year of consolidation after 3 very strong years. There are a couple of different issues right now with the market, and that technology has gotten very, very overbought, and we've seen a very big divergence in breadth and momentum. And many recall the same thing happened last year in 2024. December actually wasn't the most kind month for the market, and now it's repeating yet again. That could be an issue because a lot of the so-called Mag 7 high flyers have been starting to show some evidence of consolidation. Many that own Nvidia know the stock has really been a shell of its former self, and similar to stocks like Alphabet and Microsoft. They've all been hit very, very hard. Well, I do suspect that that improves early in the year, but I think that we're going to have, similar to this year, a period of consolidation that likely begins next spring. And I think between February and early March, we probably start to peak out and pull back into the second quarter. And I expect third quarter weakness as well. But overall, I'm bullish for the year. I think we get to 7,300. So it should just be some consolidation, but yet we end on a very good note.
And I do want to ask you, zooming in on the technicals, what's positive for U.S. markets next year, and what are some areas of concern for you?
Well, I think the metals remain an area they're still quite bullish. I mean, we're still in a time of Fed easing and the Federal Reserve likely lacking its own independence as a new Fed chair selected. I think neither party is really talking about cutting spending, so precious metals likely can do very well. I think fixed income to start the year can start on a good note where yields start to pull back, but then I suspect that yields likely can start to lift, so that might not be the best for the first 6 to 8 months. Really, it's going to be crude oil, which I believe is going to end its 3-year bear market. That likely can end the year, this year, 2025, on a bad note, but then I think we're going to start to lift. We need fossil fuels for AI, and many people are starting to change their tune about this really being peak oil. So in general, that should be a time when crude starts to lift in the first 6 months of next year. So I'm actually bullish on energy for the year, even though I sense the next couple months could be a little bit rough before we start the new year.
And Mark, while I have you here, I do want to get your technical ratings in terms of sector for 2026. So tell us about your downgrades, upgrades, and unchanged sectors.
Well, I think the retail consumer, there's been some bifurcation there, and we've seen a little bit of selling pressure in discretionary. So for me, that's going to be a neutral heading into next year. I think it's going to be really a sector you need to be a little more selective in. Let's talk about the ones I like. I like industrials, I like financials, I like utilities, and I like energy. Utilities, of course, not necessarily a defensive sector anymore. It has very much, those power centers that really serve to push AI are very, very positive, and the sector's been great. I still have to be a negative on consumer staples and also looking at the REITs. I think that even if defensive sectors have a bounce in the second quarter, I still think that over the year they're likely not to do as well. Technology for me goes to a neutral. I've been bullish on tech for years. It has gotten overbought. I'm seeing evidence of counter-trend exhaustion signals on tech. And a lot of the cycles that I look at for stocks like Nvidia actually are not too kind for 2026. So I feel that tech is going to consolidate. It doesn't mean the bull market is over. It just means we pull back, and then that's going to provide a buying opportunity, I think, for 2027 into 2028. So if tech falls next year, that means the market likely is going to have to consolidate. It's tough for the market to work without technology, of course, which is 30% of the S&P.
A lot to keep our eyes on as we head into next year.
Yeah.
But as you mentioned, next year is midterm election cycle
Right.
here in the U.S. So when it comes to seasonality as well as market performance, tell us what traditionally, historically happens and your expectations for 2026.
Well, the midterm election year seasonally has been the worst of the 4 years in the presidential cycle, unfortunately. So we've had 3 great years. Now I think we have to consolidate a bit as we head into next year. This directly gels with the own cycle that I watch, a 41-month, 180-week cycle for stocks that peaks and pulls back into 2026 before bottoming. So the two of those really go hand in hand. The one thing that's missing from the bearish case is really that exuberance that we've seen over the last couple of years. That really hasn't been seen in 2025. That we went from an era of real fear to now just more, gradual, getting on board, and you don't want to miss the rally, but people still have legitimate concerns about, the tariffs. Will they be lifted? The fight for the Fed governor, the end game for the Fed in terms of the rate cuts. The majority of the world has already, stopped cutting rates. It's really just the Federal Reserve, the Bank of England, and Norges Bank. And so, increasingly, I think we're going to shift to more of a growth perspective, and that can be helpful. But it also means that long-term interest rates likely are going to start to head higher. If healthcare subsidies are taken out in the end of January, that could be somewhat inflationary for the beginning of the year. My own view is that crude oil being as down as it is going to be a downward pressure on CPI. I also think AI definitely has a deflationary bias. So the two of those likely can offset inflation. The question is, how far does crude start to bounce? If I'm bullish on energy next year, I think eventually if we start to have a big rally, then that might be a concern.
Yeah, and Mark, finally, before I let you go, you mentioned your price target for 2026 for the S&P 500. And I think if we zoom out and look at all asset classes, we're surprised at where we're ending, at least heading into the final days of this year in terms of crypto. But we have seen that outperformance when it comes to precious metals. As you mentioned, double-digit percentage gains, outperforming the equity market. So I do want to get your gold technical outlook as well as support levels.
Look, I think gold probably gets to 5,500, 5,000 into early next year. Then we consolidate. We get down to 3,800 to 3,300 potentially at a maximum before we start to turn back higher. Look, the precious metals have gotten very overbought. It's certainly not the trade that you want to get into right now and expect multi-year gains. The RSI and gold relative strength index has gotten up above a 90 on a monthly basis. That's very, very overbought. But it's also a time when the metals are trending very, very well for a lot of the right reasons. So if interest rates start to pull back along with the dollar into early next year, that's still going to fuel the metals trade, which I think can persist into next year. Silver is really one to watch. That's been outperforming substantially in the industrial metal. That's actually a lot more bullish than gold. It's broken out of a lengthy, almost a 40-year base. You look back at the Hunt Brothers short squeeze in 1980, 79. I mean, we're up above those levels, and it's really starting to show some decent momentum. So I think investors have to have metals exposure for 2026, precious metals and base metals. For stocks, you have to be a little bit more selective, but I do like buying dips in energy. I like the financials and industrials. Transportation, is about to hit a new all-time high. So a lot of these airlines and rails still look very, very attractive to me.
Okay, Mark. Well, always great having you on. Thank you so much, and happy holidays,
to you.
Thank you so much, Mark.